The market bottom might finally be in after the 10-year treasury yield has come down and actually gone flat over the last couple of weeks. This might be setting the stage for a market recovery. So here's how I'm trading it. The treasury yield has been one of the highlights as to why the markets have been coming down over the last few weeks. Because as the Federal Reserve raises interest rates, this makes borrowing more expensive overall, so companies that need to borrow money in order to grow their business are less incentivized at these higher rates because it costs them more money, which overall slows down the economy. And over the last few weeks, TNX, which represents the 10-year treasury yield, has gone from a price of 23 to now 28. So if we divide by 10, that means that the 10-year treasury rate has gone from 2.3% to 2.8% just over the last few weeks, which is one of the fastest paces that we've ever seen. And in the meantime, we've seen QQQ, which is an ETF that contains the top 100 stocks within the NASDAQ, go from a price of around $365 all the way down to a low of $310 recently. But over the last couple of weeks, we've actually seen TNX, the 10-year treasury yield, come down and go flat. And this might be setting the stage for a market recovery. So here's how I'm trading it. Now, I already kind of predicted that this might happen on April 22nd after the IMF meeting where Fed Chair Powell basically came out and confirmed that there will be a half-point rate hike for the upcoming meeting. And if we look at the CME Fed Watch tool, there was around a 90% chance of this happening. So after Fed Chair Powell came out and confirmed this and didn't say there was going to be, say, a 0.75% hike, I figured that the TNX, or the 10-year treasury yield, would actually come down and maybe start to flatten out. It had already gone from 23 to 29, so I figured this is probably going to be a period for it to cool off. So what I did was I opened an Iron Condor on TLT, which is a 20-year treasury ETF. I'm assuming that TLT will be anywhere between $115 and $125 on my expiration date, May 6th, after the FOMC meeting. I already opened 10 of these. I got $30 of credit for each of them. And now these are going for $24, which means that I've already made $60 on this trade. But this is in the past, so let's look towards the future. Now, if I were to make a prediction, I think that volatility is probably going to come down after the FOMC meeting once we've confirmed that we're only going to get a half-point rate hike. So I would be betting with UVXY options. I would stretch my expiration date 2 weeks out, so 1 week after the FOMC meeting, and then I would be buying put options assuming that it's going to come down. So if I were to buy a UVXY put option, I think that it could be below $16 on May 13th, so I would buy this $16 put option for $208. But this means that UVXY actually needs to drop to $13.92 in order for me to make a profit on this trade if I hold it into the expiration date. But I think that the chances of UVXY coming down after the FOMC meeting, after we get that confirmation of just a half-point rate hike and not a 0.75 rate hike, this should drive the price of UVXY down, since this has been one of the main fears that's being priced into the market. And when UVXY drops and the yield goes flat, like I'm assuming, what's probably going to happen is we're going to see a recovery for QQQ. So if we look at recent price levels for QQQ, I think that it's reasonable to assume that we might be over $327 over the next month after we get this FOMC fear out of the way. So the way that I would probably trade this would be by going to QQQ options, and instead of buying a regular call that would be too expensive for us, if we go to May 20th as our expiration date, we're going to assume that QQQ could be above $327 by next month. So I would do a call debit spread by buying a $326 call, selling a $327 call, and for this I'm going to pay $51 for each of these spreads that I open. Now, I'm not going to go balls to the wall and put my life savings on this, but I might buy, say, 5 of these and spend $250, and I have the chance to make $245 if I'm right. Now, I don't have a crystal ball, and I'm not 100% accurate in predicting the future, but I think that there's a decent chance if the yields go flat like I'm expecting, then QQQ should recover. So that's how I'm trading the market recovery. Hopefully you found this video useful. If you did, show some love, leave a like. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.